Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm lucky enough to be joined by Strategas Managing Director and Investment Strategist Ryan Grabinski to talk all things markets. But first, Ryan, how are you doing this morning?
I'm doing well. It's coming up to the end of summer here, so things are starting to slow down a little bit, but we keep chugging along. How about yourself?
That's right. August is a bit of a sleepy month, but there's plenty to talk about here. And I do think that, we're right around 10 months off of the October 22 lows. And I think it's a good time to kind of take stock of what has happened in the economy. I mean, you had this widely anticipated slowdown or recession that hasn't really materialized. And so I think we have to ask, what was the reason that that didn't happen? And then can the strong patch we're in now continue going forward? So I want to turn that question over to you and get your thoughts on it.
Yeah, certainly. So I'll address the strong patch first. Obviously, we're going through a strong patch here. I was looking at the Atlanta Now GDP forecast for the third quarter, and it's all the way up to about 5%. So obviously, that suggests that the economy continues to do well. A big portion of that is actually related to consumption. Obviously, on the consumption side of things, we look at our consumer stress indicator, which looks at food prices, gas prices, financing rates for homes. That continues to come down. Actually, it's still at elevated levels, but it has fallen from the peaks of that we saw about a year ago. I'd say if Visa also has a spending momentum indicator that we watch, and if you look at, they break it out between discretionary and non-discretionary items. And the discretionary line item is actually showing strength here. So clearly, consumers continue to do well. The labor market continues to hang in, which is probably responsible for a lot of that. I think one of the things that has gone underappreciated over the last call it 12 months is that there's actually been a stimulative aspect to the Fed raising rates here. Obviously, the saber was repressed for 15 years in this ultra low interest rate environment, and consumers now who have built up savings are actually getting paid something on that savings to the tune of 5%. That's additional income that they didn't have in the years past, and that's obviously income that's likely going to be spent. If you see your savings account is growing by doing nothing, you're more likely to spend that. So if you think about travel and leisure is one area where that's likely to be spent. If you think about just going out to dinner, and if you used to go out once a week, maybe you go out twice a week with that extra income. So the services industries continue to benefit from that. You can even extend that into some of the headlines that we've seen recently with regards to some of the movie releases. Obviously, they've done well. Consumers have certainly gotten out and wanted to spend on various forms of entertainment. And I think the higher savings rate is a part of that. If you couple that with the cash that corporations have on their balance sheets as well, they're also generating income that they hadn't generated in the past, and that might potentially help them to maintain their employment base if they do need to. If they did have the idea of needing to cut costs somewhere, maybe they say, hey, we actually don't have to cut costs. Layoffs aren't necessary. We do have this additional income that we're generating from the cash that we're holding in our savings account, and maybe they're holding on to employees for that reason. So I think the stimulative side of the equation from higher rates has actually gone underappreciated in the market environment, and that's actually allowed sectors like discretionary, industrials, technology to actually continue to hang in well.
Yeah, I think that's a really great point. And you pair it with the fact that a lot of people were able to refinance fixed rate debt at super low rates during the pandemic. And it's almost like higher rates are having, somewhat at least the opposite effect of what they were intended to have. But ultimately you have to take this economic momentum that we're seeing, and it has to translate to corporate earnings. They're kind of the underpinning of the stock market and the equities that we invest in. So we're kind of at the tail end of an earnings season here, a pretty important one, I think, or at least kind of a turning point. I just want to turn over to you. What are you seeing out of earnings? What are some important takeaways, and what's the overall outlook going forward?
Yeah, the 2Q earnings season has certainly come in better than expected. At the beginning of the earnings season, growth was expected to be down a little more than 5.5%. That is actually, the gap has closed. Now it's expected to be down about 3.8%. And that's actually even better than what the April 1st estimate was. for the second quarter. So clearly there's been a significant improvement in that arena. I'd say discretionary is one of the sectors that has been responsible for that. The true laggard obviously has been the energy sector, which of course we're lapping those high oil prices we saw about a year ago. So that's not really all that surprising. But if you think about going forward, we're actually going to start to see the trough. We could potentially be at trough earnings for the energy sector, and that could actually be accretive as we head into the back half of the year and into 2024, given that oil prices are on the rise. I think another item that you have to think about is when you look at the annual estimates. So 2023, it had been as low as $218 a share. $218 a share, and it's actually back up to about 221. The 2024 estimate is all the way out to $246, and that's a growth rate of about in between 11 and 12% for next year. If you think about taking a step back now, if you think about 2023, throughout the first two quarters, we've had $106 of earnings, and historically, if you look at the contribution by quarter, that contribution for the first half of the year is usually around 48.7%. So if you extrapolate that out into what full year earnings would be this year, you actually get something along the lines of about $218. So if you think about there's a lot of talk about recessionary type earnings. I think that talk has to sort of dissipate now because it's just getting harder and harder to kind of get to those recessionary levels on the earnings front for this year. Obviously, we could face some sort of financial contagion event, and we could walk back all of these comments, but I don't think that can be your base case anymore. Just knowing what the Fed did in March, stepping in and saving SVB.
Right, I think that's right. And to your point about earnings accelerating into year end and certainly 2024, you kind of need that because the multiple that the market is trading at right now is pretty elevated, especially with where interest rates are. So something to watch for sure, and we'll be certain to have you back on to talk about it in the future. So Ryan, thank you so much for the time as always.
Absolutely, Ross. Always great to be here.